Okay, so just want to look at the ledger entries, the double entry accounting for corporation tax. This is actually a topic that you would have studied in second year, but just want a refresher prior to including this aspect in the question solutions. Okay, so we're going to look at the relevant ledger accounts used to record corporation tax, the double entry, in respect of recognising a corporation tax liability and then paying it off, and then dealing with any under or over provisions of corporation tax which may arise. So the two accounts, tax liability account, and again in that big red lettering, liability tells you all you should need to know about the nature of that account. So that's going to be a balance sheet account. Obviously liability is an item which has a credit balance. So if you wish to create a liability, you're going to have to credit the liability account. And then the other tax account is the expense account, corporation tax expense account. This presentation does not include deferred tax. It's just focusing on the actual payment amount or the liability amount that will be required by the company to include in its financial statements. So the tax expense account, as the keyword expense should tell you, it's the figure that will appear in the income statement of the profit and loss as the tax value in that document. So to record liability, okay, you should credit the liability account. This should be second nature to you at this stage, and debit the relevant expense account. So that's the recognition of the liability. So if you estimate your current year liability to be €10,000, you'll debit the expense account and you will credit the liability account with the €10,000. And when you ultimately pay off that liability, you can see you'll credit bank, okay, reduce what's in the bank, and debit the liability account. So in theory, the liability account will be zeroed if the initial amount recorded matches the amount paid. But that doesn't always happen. So you could have this situation where the payment doesn't exactly equal the amount recorded as a liability. It could be due to errors in a calculation or differences of opinion about the tax treatment applying to relevant items, or whatever whatever reason that gives rise to it. But you will have a balance remaining on the liability account under such circumstances. So that balance needs to be dealt with. And as you may recall, this is either going to be an under provision or an over provision in respect of corporation tax. So under provision, again, if you just listen to the words, under provision, you under provided for your corporate tax liabilities. In other words, you did not provide enough in your balance sheet. You thought you owed €1,000 and it actually turned out that you owed €1,100. So there's an under provision. That extra €100 represents an under provision, and vice versa. There's an over provision which occurs when you thought you owed €1,000, but in fact you only owed €900. Okay, so when you pay off the €900, you still have €100 left in your balance sheet. So we need to eliminate these. This slide just outlines how the CT liability account will show a debit value if there's an under provision, or credit value if there's an over provision. Again, you should be able in your minds to work out why it would be a debit or a credit. So to take the under provision, if we initially assume our liability was to be €1,000, so we've got a credit balance in the liability account, we then ended up paying €1,100, so credit bank, debit liability. So the debit liability with €1,100, that you should be able to see will leave a net balance of €100 on the debit side of the liability account. Okay, so that's the under provision, and you can go through the same logic to ensure that you are okay with the reason why an over provision is the credit side of the liability account. Irrespective of whether the balance is debit or credit, the amount represents something that needs to be eliminated. They're neither an asset nor a liability of the company. We don't owe more money to the company, or we aren't going to get a refund from the tax office. So the treatment of under and over provisions is to take it out of the liability account and transfer it into the tax expense account. So you will either debit the liability account or alternatively credit the liability account, depending on whether you're talking about under or over provisions. So what I now want to look at is other elements of accounting for tax-related items. So you can see the title, Accounting for Tax Credits and also Tax Withheld on Charges. So tax credits, things like the DIRT credit, the R&D tax credit, and tax withheld on charges. Okay, so you deduct tax from, say, a patent royalty payment that you make. That must be paid over to the tax office ultimately, so there has to be a recognition of that liability. Okay, so the first one is an easy one, accounting for the tax credit for DIRT. Okay, so when you receive interest, assume that you receive, say, €100 interest net. You'll debit bank and credit interest income account. That represents the net interest. But you need to include the gross interest in the financial accounts. So you need an additional credit to the income account, and you debit the tax liability account with the related amount of DIRT. Remember, for companies, DIRT is a refundable tax credit, so it reduces the liability account. So again, debit CT liability account. So that's a fixed set of entries: debit tax liability, credit deposit interest in respect of DIRT withheld by banks. Tax withheld on charges, again, a pretty straightforward one. The amount that you pay, so say you owe a liability, say you owe a patent royalty of €1,000, and you actually pay the individual 1,000 minus 20% tax withheld, so you pay 800, so you credit bank, debit patent royalties, so you've got €800 in the patent royalties expense account. You need to include the tax effect so that the total expense is reflected in the account. So debit the charges account, so debit patent royalties, and credit tax liability. And again, that is a fixed accounting rule. So debit the charge expense account, credit tax liability, with tax that you withheld on payments of patents or covenants. Now, the R&D tax credit was one that was the subject of some consideration, and how to actually debit and credit the value of that R&D tax credit in your accounts. It should be evident that the value of the credit is effectively an asset of the business, so there has to be some debit somewhere in the balance sheet. The question is where and how to make the corresponding credit. So the two alternative treatments were, as indicated here, treated as if it were a government grant, which is a far from obvious way of looking at it, and the second method, treated as a reduction in current tax, probably the way that you would, if you were trying to figure it out, come up with yourselves. But this actual first method has quite a lot of merit, and we're going to look at the detail of that now. Okay, so we want to, first of all, I suppose, break the process into three main steps. First, there's the initial recognition of the value of the credit. So we have to create an asset to recognize this credit. So there has to be a debit and the corresponding credit. So the suggested approach is debit deferred tax asset account. Okay, deferred tax asset account, and credit deferred income account. Okay, now deferred income would be in the same section as provisions. Okay, so accrued income or deferred income goes into provisions. So that's just to recognize the value of the credit. And then as we actually get to use up the credit, okay, we're going to reduce the deferred tax asset, so credit deferred tax asset account and debit tax liability account. Okay, so we set the credit against our tax liability. So again, that's reasonably logical once you've got that initial step done. And then finally, as we amortize the R&D, we offset the deferred income. So debit deferred income account and credit government grant income in the P&L on the income statement. Okay, so it's actually quite a good method when you've had some time to consider it, but it is far from intuitive or far from obvious. So there's this initial recognition of the asset, debit asset, credit deferred income account, which is a kind of a provision. Then use up the asset, so credit deferred tax asset against liability, debit liability, and then get rid of the deferred income as the R&D is charged to expenses. The alternative method is accepted but is arguably inferior, although it's the more intuitive method that you may figure out when thinking about it. So this recognises the initial credit, so it's debit deferred tax asset as before, and they credit the corporation tax expense account in the P&L, so they reduce the current period's tax expense. The slight challenge with that, or the issue that many would have with that, is that the credit is used up potentially over time. It shouldn't really use up all against the current tax expense, and that may mislead analysts or readers of the financial statements. However, it is an accepted method. And then the use of the credit, debit tax liability, credit deferred tax asset, okay, similar to before. There are some management accounting issues that companies availing of the R&D tax credit can use it in a certain way. This often helps them to win projects and investments into Ireland. It doesn't really have an impact on the actual financial accounting, however. Okay, so this last part of the presentation is concerned with the accounting entries in respect of deferred tax. So this relates to an earlier slide, IAS 12, where I showed how we need to compare accounting book values and tax-based values of assets and liabilities in order to determine total differences for the purpose of calculating deferred tax. So once we have this deferred tax provision, 12.5% of the total differences, we need to actually incorporate that into our financial statements. The next slide deals with that. So the calculated balance is the desired closing balance on deferred tax. So that's going to typically be a liability, so you need to adjust the liability account provision for deferred tax account to ensure that the closing balance is updated. And that usually represents a movement on deferred tax. So you may have an opening balance on deferred tax of, say, €1,000, and the desired closing balance is now 1,500. So you're going to have to credit an extra €500 to the deferred tax account. The corresponding debit is in the tax expense account. And obviously those entries may be reversed if the deferred tax opening balance needs to reduce. You would debit the liability account and credit the tax expense account.